There is a man in Zurich, we'll call him Heinrich, who has never once checked a stock price. Not once, in 40 years. He owns a position in a private real estate fund that has returned 11% annually, compounding, since 1987. He has never sold a share. He never intends to. And here is the part that will stay with you. Heinrich is not exceptional. He's not a genius. He did not invent something or disrupt an industry. He simply learned, early in his life, a small set of invisible rules that most people will never hear, and he followed them without deviation. That is what separates the ultra-wealthy from everyone else. Not luck, not intelligence. Rules. Today, for the first time, we open the vault. The vault opens in 3, 2, 1. Every Saturday, this vault opens. And inside, no speculation, no motivational fluff, no get-rich-quick mythology, just decoded truth about how the ultra-wealthy actually operate. Financial journalism meets documentary. Precision meets access. Welcome to Velvet and Vault. Welcome to the vault. I'm your guide. And today, we're starting at the foundation. Decoded rule number 1. They don't own wealth, they structure it. Ask most people what the ultra-wealthy have that they don't, and they'll say money. Wrong. They have structure. There is a concept in high net worth financial planning called asset segregation, and it is the single most underexplained mechanism of generational wealth. Here's how it works, in plain terms. The ultra-wealthy do not hold wealth in their personal names. That is not an accident. That is a strategy so deliberate, so consistently applied across billionaires, family offices, and centuries-old dynastic wealth that it functions less like a financial tip and more like a law of nature. They use entities, trusts, holding companies, family limited partnerships, private foundations. Each one is a container, legally distinct, strategically positioned, and each container has a job. One container holds real estate, another holds equities, another is the operating business, a fourth is the philanthropic vehicle. And at the top, invisible, often offshore, always legitimate, sits a structure that controls them all. Why does this matter to you? Because most people build wealth like a pile of sand. Every gain sits in one place. One lawsuit, one divorce, one market event, one tax bill, and the pile erodes. The ultra-wealthy build wealth like architecture, distributed, load-bearing, designed to withstand force. The rule isn't make more money. The rule is, before you make more money, build the structure to receive it. That is decoded rule number 1. Decoded rule number 2. Their most valuable asset is not on any statement. If you were to look at the portfolio of a generational wealth family, say a fifth-generation family office in Geneva or Singapore, you would see something unexpected. The largest single line item would not be stocks, not bonds, not even real estate. It would be something the statement calls alternatives or private holdings, and what that category conceals is more interesting than anything it reveals. The ultra-wealthy are overweighted, radically overweighted by conventional standards, in assets that ordinary investors cannot easily access. Private equity, private credit, direct real estate, timber, infrastructure, art held as a store of value, stakes in pre-IPO companies. But here is the decoded insight. It is not the asset class itself that is the advantage. It is the illiquidity premium. The ultra-wealthy have structured their lives, their income, their expenses, their entire financial architecture so that they never need to sell. And because they never need to sell, they can hold. And because they can hold, they earn what the market charges for patience. The illiquidity premium, the extra return that comes from locking capital into assets that cannot be easily sold, can range from 2 to 5 percentage points above comparable liquid assets. Compounded over decades, that gap does not grow linearly, it grows exponentially. The invisible rule. Patience is not a personality trait among the ultra-wealthy. It is a financial instrument. It is engineered. It is structurally enforced. They don't choose to be patient. They build a life in which impatience is impossible. That is decoded rule number 2. Decoded rule number 3. Access is the actual currency. There is an investment that has generated conservatively more wealth for more ultra-high net worth families than any publicly traded asset class in history. It is called a phone call. The relationship economy is real, and it operates in a completely different register from the one most people inhabit. Let me give you a concrete illustration. In 2009, at the absolute trough of the financial crisis, a handful of family offices and ultra-high net worth individuals made direct investments into companies that no retail investor, no ordinary institution, and no ordinary fund could access. They weren't buying stocks on an exchange. They were writing checks directly to distressed businesses in exchange for preferred equity positions. Why did those businesses take their calls? Because of relationships built over decades. Because the ultra-wealthy had been writing checks in good times, sitting on boards, making introductions, creating value without expectation of immediate return. The return came in 2009, and it was extraordinary. The invisible rule at work here is one of the most counterintuitive in all of wealth. The ultra-wealthy almost never enter a relationship to extract value. They enter relationships to deposit it. They make introductions that don't benefit them. They share information that doesn't immediately profit them. They sit on boards, advise founders, mentor the next generation, not out of altruism alone, but because they understand that relationship capital compounds. The person you helped in 2005 has a deal flow in 2015 that they will offer to exactly 4 people. You will be one of those 4. That is not luck. That is the deliberate architecture of a relationship economy, and it is completely invisible to anyone who is not inside it. Decoded rule number 3. Access is the actual currency, and it is earned, not purchased. Decoded rule number 4. They don't avoid tax, they time it. One of the most persistent myths about ultra-wealthy individuals is that their primary financial strategy is tax avoidance. It isn't. Aggressive, illegal tax evasion is a game played by the new rich, the newly wealthy who haven't yet learned the rules. It is loud, risky, and ultimately self-defeating. Generational, institutional ultra-wealth plays an entirely different game. They time tax. The mechanism is called tax deferral, and it is far more powerful than most people understand, not because of the tax savings themselves, but because of what is done with the capital that would otherwise have been paid. Here is the most elegant version of this principle as practiced by some of the oldest family fortunes in the world. Never realize a gain you don't have to realize today. Borrow against appreciating assets rather than selling them. Utilize stepped-up basis at death to eliminate embedded capital gains across generations. Let the structure, the trust, the holding company, the foundation, do the tax work, not your tax preparer, the structure. And here is the deepest layer of this decoded rule, the one that separates the sophisticated from the merely wealthy. The ultra-wealthy do not think about minimizing what they owe this year. They think about what they want to owe in 40 years. They think generationally, structurally, architecturally. The tax code was not designed to harm them. It was, in many respects, in their view, designed to reward exactly the behaviors they already practice: long-term investment, capital formation, philanthropic giving. They are not beating the system. They are the system's intended beneficiaries. That is decoded rule number 4, and it may be the most uncomfortable truth in this entire vault. 4 invisible rules. Structure before accumulation. Patience engineered, not chosen. Access earned through deposit. Tax timed, never merely minimized. These are not secrets that were hidden from you. They were never the subject of a conversation you were invited to. That is a different thing entirely. And it is perhaps the 5th invisible rule, the one we didn't formally decode today. The ultra-wealthy operate within a layer of financial reality that most people simply don't know exists. Not because it is illegal, not because it is immoral, but because it is never discussed in the places where most people learn about money. You won't hear these rules at a bank. You won't read them in a best-selling personal finance book. You won't encounter them at a standard financial planning appointment. You hear them here, every Saturday, when the vault opens. If this episode gave you something to think about, something you hadn't considered before, then you belong here. Subscribe to Velvet and Vault. A new episode of The Vault drops every Saturday. No filler, no noise, just decoded truth, delivered with the precision and the depth this subject deserves. Hit subscribe, turn on notifications, and come back next Saturday. The Vault will be open. Next week in The Vault, ultra-wealthy decoded number 2. Why the rich keep getting richer. It's not what you think. The wealth gap isn't growing because the rich are greedy. It's growing because they operate by a completely different set of financial physics. How does it work? Who runs it? What decisions does it make? And what decisions are deliberately kept from even the family members it serves? Next Saturday, The Vault opens.